Hello friends, welcome back to the channel guys. In today's video, we will discuss one of the best investing approaches you can implement in your investing and ensure that you make a lot of money, and more importantly, you follow the rule number 1 of Mr. Warren Buffett, which is never lose money. Okay. Now, this philosophy and this approach, what we're going to discuss today, is very less known by people. Very few people are actually practicing this, but the reason why, because nobody gets any benefit from this. Only people who use it are the ones who are compounding their wealth. But otherwise, people who are selling financial products like mutual funds, index funds, they don't benefit from this, right? So a little bit about me before we begin this. So I am someone who has over close to 10 years of experience in investing, more than 10 years at this stage, but around 10 years of investing experience, and I have a CAGR of around 26%, right? Close to 26% for these 10 years. This is my compounding. So Warren Buffett always says that if you're not able to explain your investing philosophy in 2 lines, then you are not a good investor. You are a speculator, right? So in today's video, we will explain the investing philosophy which I personally follow till date, although I have a satellite portfolio where I go into individual stocks. And that again I've covered in a separate video, but in today's video we'll just discuss this investing philosophy, right? And a little bit about me. I have a master's and a PhD in biochemical engineering from IIT Madras and an MBA from ISB, and I'm working in the corporate sector from around 6 years now. Okay, so this is my philosophy, and this is a little bit about me. And on my free time, investing is my passion, along with 2-3 other things I do in my free time, but this is what I love, and on this channel I share my philosophy, right? So of course whatever I've learned have come from books and Warren Buffett. So what you have to understand if you want to invest is that most people understand compounding, right? What is the name of this channel also? Most people understand compounding, but they are not understanding it in the real sense. Well, compounding can only happen. Compounding, which is your 2 becomes 4, your 4 becomes 8, 8 becomes 16, and 16 becomes 32. In stock market, for compounding to happen, you have to have a very simple decision making in place. Your decision making has to be very clear, otherwise you cannot handle big portfolio, right? And for that you need a vehicle to invest. So the vehicle which we will be using here is ETF, and particularly Nifty 50 ETF, right? Now when we use this as a vehicle to compound our money, what does it mean actually? With the framework which we will be discussing today, you can basically evaluate whether Nifty 50 is expensive, it is moderately expensive, or cheap, right? And this is a complete financial freedom framework, so watch and listen very carefully guys. This video can change your life forever, right? Because it will just clear your thoughts, and how to draw passive income from stock market also learn over here. So a good number to live in India comfortably is 20 crores, right? We have to get over there, and how can we go there? By compounding. So if you compound your wealth at 25 to 26%, you're basically doubling your money every 3 years, right? Every 3 years you're doubling your money. Now, considering 3 years as a doubling time, in a span of 20 years, how many doubling cycles you have? So you have close to 6 doubling cycles. So if you're someone who's in a job and somehow you're able to accumulate 20 crores, 20 lakhs, 20 lakhs of money, and you have 6 doubling cycles. So in the first doubling cycle, your 20 lakhs becomes 40 lakhs. In the second, your 40 becomes 1.2 crores. Your 1.2 becomes 2.4 crores. 1, 2, 3, 4.8 crores. Here it becomes 8, 9.6 crores, and 3, 4, 5, and close to 20 crores in the 6th doubling cycle. So in mere 20 years you are reaching 20 crores. Now in a corporate job, this number is very achievable for you if you're in a decent job, right? 20 lakhs anybody can save these days, right, in India. So getting there in 20 years is a very practical plan, right? You can easily get there in 6 years if you follow this philosophy which we will be discussing today. So what we have to target is 25 to 26% CAGR. Now how can you do this in a vehicle which is safe? So very importantly, understand the vehicle or the investment asset. What you are choosing here is Nifty 50 ETF. It's not an individual stock. It's not some individual stock which can go to zero. Nifty 50 can never go to zero because it's a cluster of 50 best companies in terms of market valuation in India. If it tries to go to 20-30% down, the government will pump in money because the government has to show its performance. The RBI will decrease the interest rates and they will be borrowing and the economy will be boosted up. So it will never go to zero. That's what I'm trying to say. And if you assume that Indian economy and in GDP will maintain its growth rate, India being a developing a country at 8%, and you get earnings growth as well as some growth from the price action, you're easily able to compound your wealth at close to 8 plus 6, which is close to 14% in Nifty 50 itself if you stay for the long term, right? But with this approach you can increase this 14% to 25 to 26%. Now how can you do this? So this is very simple, right? And whoever will miss this will be losing a lot in their career. So we have evaluated from this fundamental analysis that whenever Nifty 50 is above 24 P by E, and you can calculate the P by E of Nifty 50, you can check it from Trendline. Trendline is a website, check it out over there. Right now it's 21.9, close to that. So when it is 24, it is expensive. When it is between 19 to 22, it is neither expensive nor cheap. And when it is less than 19, it is very cheap. So what you have to do as an investor is you have to accumulate your money either in some mutual fund or in Nifty 50 below 22 P by E ratio, right? Never invest your money in Nifty 50 when the ratio of P by E Nifty 50 crosses above 22, because then it goes into the expensive category and you'll not be making good returns over that money. So hold, and when it goes above 22, go into debt mutual funds or fixed deposit, but I would prefer debt mutual funds, and here liquid funds, because they are very liquid and you don't have to, you just have a hold up time of maximum a week in most of these funds, right? And just maintain this, and whenever it comes back below 22 again from above 22, then you start investing in Nifty 50. Now what this money you have accumulated in debt mutual funds, whenever Nifty 50 goes, and you'll get these times in like 3-4 years time window, whenever it goes below 19, you pump all this money in burst SIP over a period of like 2-3 months in Nifty 50 ETF again. And if you do this, we have done this back testing, you get a CAGR of around 25 to 26%, which basically ensures that you compound your wealth in 20 years. Now if you're someone who wants to retire early, right, and you want to reach 20 CR, but you want to also enjoy your life, right, I would say you should definitely wait till 2 CR. Till 2 CR you definitely wait, and you just follow this plan what I've shown you. Nifty 50 investing is the best investing, right? But yeah, so follow the plan up to 2 CR, and I'm giving you a decision making framework which I follow. And above 2 CR, you divide your portfolio into two types. First, liquid fund and your Nifty investments, Nifty ETF investments, and second, your complete debt. Now this can be your fixed deposits or your gilt funds or your separate short-term funds, which are like moderate bonds, moderate maturity bonds based funds, right? Any of the debt, right, debt asset class. And here you park 20% and 10% in gold, right, and rest 70% in equity. Now what will happen as a result of this? What will happen is this shift this 70%, and you make this balancing every year. So next year your portfolio will be, let's say, 3.5 crores. You again draw some money from this increased equity and distribute it in this manner, right, in this manner. And when you do this, you will basically ensure that you always have money to spend. So your debt money, which is on 20%, meaning 40 lakhs, will have an interest of, let's say, 7 to 8%. So you're getting what, like close to 88 for 32, 3.2 lakhs. This is the money which you can afford to spend, the interest generated on your debt portfolio, and you freely spend this, right? So this money will continue to generate your interest, and every year this debt portfolio is increasing. So this interest will also increase, and lifestyle will also increase. But my highly recommendation is you do this over 2 crores only, right? Don't do it below that, otherwise your compounding corpus is not big enough to compound to 20 crores, right? So do this, guys, and this is a very simple way to invest and ensure that you enjoy your life also, and you ensure that you create your wealth also. And the best part, you will never go bust. Nothing can touch you because you're investing in Nifty 50, which can never go to zero. That's the best part. And nobody will teach you this, because nobody gets benefited from teaching you this, right? It's something which I have discovered from the books I've read and the courses I've done, and it's the best strategy to live a wonderful life from investing in stock market. This is a thinking framework. So let me know in the comment section below how you like this video. I hope you liked it and this has been game changing for you. Let me know in the comment section below how you like it, guys. Thanks again for watching the video, guys. I'll see you again in the next one. Till then, take care, bye bye, and I will see you again soon. Thanks for watching. Bye bye.